Over $13 billion. I mean, just sit with that number for a second.
It's a massive figure.
Right. That is the top line annual sales figure that Darden Restaurants just dropped in their fiscal 2026 fourth quarter earnings call. We are talking about a legacy brick and mortar restaurant operator moving a volume of, pasta, steaks, margaritas that honestly rivals the gross domestic product of some small nations.
Yeah, it really does.
So welcome to this deep dive. Today, we're taking you deep into the corporate machinery behind that $13 billion. We're carrying through the Darden transcript. And for those who don't know, they're the parent company of Olive Garden, Longhorn Steakhouse, Yardhouse, the Capitol Grill.
All the heavy hitters.
Exactly. And we want to figure out exactly how they are putting up tech-level growth numbers in a physical retail space, doing what is an incredibly turbulent macro environment. Our mission here is to bring a data-forward, plain language approach, right? To translate all that Wall Street jargon into actionable insights for you, the retail investor.
Which is so important because, it is a staggering top-line number, but the real story we found buried in this transcript isn't actually about top-line vanity metrics at all.
No, it's not.
It's an absolute masterclass in supply chain economics, ruthless portfolio management, and a highly contrarian pricing strategy. When you peel back the layers of these Q4 results, you realize Darden is operating a completely different playbook than the rest of the casual dining sector.
Okay, let's unpack this. Let's get right into those headline Q4 results, because the divergence between Darden and the broader industry is it's the first thing that jumps off the page.
Oh, absolutely.
They are looking at Q4 total sales of $3.7 billion. That's a 13.7% increase year over year. Now, reading through the management's commentary, they do acknowledge a structural tailwind here. They had a 14th fiscal week in this quarter compared to last year.
Right, which obviously skews things.
Yeah. Exactly. An extra week of operations naturally nudges the absolute totals up. But even when you strip out that calendar noise and look strictly at same restaurant sales, they are posting a 4.6% comp.
Yeah. And that 4.6% comp is really the linchpin of their entire Q4 narrative. So for the listener, let's translate that Wall Street jargon real quick. Same restaurant sales, or comps, is the true metric of a restaurant's health.
Because it strips out the boost from newly opened locations.
Exactly. If you just open 50 new restaurants, your total sales go up, but it doesn't mean your existing restaurants are actually doing well. So to understand the gravity of that 4.6% figure, you have to look at the industry benchmark data they provided alongside it.
And it is not pretty for the industry.
No, it's really not. For the exact same period, the broader casual dining industry saw comps increase by a meager 1.4%.
Wow.
But even more alarming for the sector, industry-wide foot traffic, like the actual guest counts, was down 1.8%. So the industry at large is seeing fewer people walking through the doors. And the only way they are scraping together that 1.4% sales growth is by aggressively hiking menu prices.
Which means the consumer is essentially paying more but dining out less. I mean, that's a completely unsustainable dynamic for a lot of these smaller operators.
It is. The industry is basically cannibalizing its future traffic just to protect current quarter margins. Meanwhile, Darden beat that industry comp average by over 300 basis points.
That's huge.
In the context of a highly mature, heavily saturated market like casual dining, a 300 basis point outperformance isn't just, a statistical anomaly. It is a violent taking of market share. They are actively pulling guests out of competitors' dining rooms and into their own.
Yeah, and that market share grab flows straight down the P&L. Looking at the profitability metrics, their adjusted diluted net earnings per share, or EPS, for Q4 jumped 22.8% to $3.66.
That's a massive.
Right. And for the full year, EPS hit $10.64. Mm-hmm. And management is extremely clear on what they're doing with that cash flow. They're returning it to shareholders like you. In fiscal 2026, they returned $1.4 billion, $693 million in dividends, and $675 million in share repurchases.
Which is exactly what you want to see as an investor.
Right. But wait, I have to push back here on the underlying math.
Okay, go for it.
Because the transcript explicitly mentions elevated commodity costs. We all know beef inflation has been brutal. Labor rates are up. If your input costs for food and wages are climbing, your margins should be under immense pressure. Yet, they somehow managed to improve their restaurant-level EBITDA margin by 50 basis points to 22.1% in Q4.
Yeah, it seems counterintuitive.
How do you expand your operating margin by 0.5% when the raw materials to run your business are getting noticeably more expensive?
So it comes down to the aggressive application of sales leverage and highly disciplined labor productivity. When you generate the kind of volume Darden is seeing, pushing past $3.7 billion in a single quarter, the underlying economics of the restaurant model fundamentally shift.
Okay, how so?
Well, your variable costs, like the beef or the pasta, obviously scale with every plate sold. You pay more for the food you sell, but your fixed costs, the real estate leases, regional management overhead, national marketing spend, the depreciation on kitchen equipment, those remain entirely static.
So because the sales volume is so high, the denominator gets bigger, and those fixed costs basically shrink as a percentage of the total revenue.
Precisely. If you can drive an extra 50 or 100 guests into an Olive Garden on a Tuesday night without needing to, add an extra manager on duty or pay more rent, the profit margin on those incremental guests is wildly higher than your baseline average.
Oh, that makes a lot of sense.
And the transcript gives us a very clear look at this dynamic in action. Management actually noted that restaurant labor costs were 40 basis points lower as a percentage of sales, despite total wage inflation running at 3.2%.
So that is the productivity piece. They are absorbing a 3.2% bump in hourly wages, but because the restaurants are so busy and the scheduling is so optimized, the total labor bill as a percentage of the revenue goes down.
Right. They're essentially serving more guests per labor hour. They've stripped out kitchen complexity, optimized their prep times, and ensured that the staff on the floor is operating at maximum capacity without, burning out. It's operational leverage functioning exactly the way it's supposed to in a textbook model.
But you can't optimize your way to $13 billion if the actual brands in the portfolio aren't resonating with the consumer.
True.
So let's transition from the macro numbers to the specific brands driving this engine. I want to talk about the power of their diversified portfolio, starting with the absolute juggernaut of this quarter, which was Longhorn Steakhouse.
Oh, Longhorn was incredible.
The numbers Longhorn put up are frankly absurd for a legacy steakhouse chain. We're talking total sales up 21.9%. Same restaurant sales up 9.5%. They outperformed the casual dining benchmark by a staggering 810 basis points.
It's almost unheard of.
Average unit volumes are now sitting at $5.6 million. A 9.5% comp in this economic environment really demands an explanation. What is the specific catalyst driving a stampede into Longhorn?
It is a really interesting confluence of a long-term operational strategy slamming into a very specific macroeconomic tailwind. Management was quick to point out that this isn't a flash-in-the-pan quarter for Longhorn.
Right, they've been building this.
Yeah, they have been methodically investing in food quality, steak sizing, and execution consistency for an entire decade. Their guest satisfaction scores for steak preparation have been steadily climbing and are currently sitting at all-time highs, so they built the foundation.
Okay.
But the immediate catalyst, the reason for that explosive 9.5% jump right now, is directly tied to what is happening at your local grocery store.
Oh, the grocery inflation dynamic.
Yeah. Exactly. The transcript zeroes in on the fact that beef inflation is hitting the retail grocery channel significantly harder than it is hitting institutional buyers. Retail steak volume at grocery stores is actually down 8.5%.
Wait, really? Down 8.5%.
Yeah. The psychological threshold of the consumer standing at the meat counter, looking at the price of a raw ribeye that they still have to take home, season, cook, and clean up after it's been crossed.
So the value proposition completely flips. If you were going to spend $35 buying raw steaks for a Tuesday night dinner, and Longhorn is offering a perfectly grilled, heavily portioned steak with sides in a full-service environment for marginally more, the decision basically makes itself.
Exactly. Longhorn is effectively capturing the displaced grocery shopper.
That is fascinating.
The gap between food at home and food away from home has compressed specifically within the beef category, and Longhorn's historical investment in quality means they are perfectly positioned to catch that trade-off. They've positioned themselves as an accessible luxury, and they are backing that up with incredibly sharp localized marketing.
Yes, I wanted to bring this up. You're talking about the lamb campaign. I read that section of the transcript, and it is a fascinating case study in understanding your core demographic.
It really is.
So Longhorn traditionally runs a lamb feature in the fourth quarter. But this year, instead of spending millions on a massive, broad-reach national television campaign, they dropped a highly targeted, vague social media teaser simply stating, "What you're looking for is coming."
And the response was immediate. It went entirely viral within their specific fan base. Management noted they actually procured more lamb this year than the prior year, yet they still sold out of the inventory in half the time.
That's wild.
Right. It demonstrates a level of brand heat and digital engagement that you rarely see in a legacy casual dining concept.
It's the kind of engagement you expect from, like a limited edition sneaker drop, not a lamb chop at a steakhouse. But while Longhorn's providing the explosive high beta growth, we have to look at the absolute bedrock of the Darden portfolio.
Olive Garden.
Exactly, Olive Garden. Now, Olive Garden saw a very solid 2.4% comp growth in Q4 and 4% for the full fiscal year. The CEO specifically noted that 4% is above the high end of Darden's long-term internal framework.
Right, which is a big win.
But I want to dig into a very counterintuitive data point buried in the Olive Garden metrics. Management spent time discussing their newly introduced lighter portions menu. They revealed that this specific menu section caused an 80 basis point mix headwind to the average check.
Meaning people were spending less per visit.
Exactly. The average table spent less money because they were opting for these cheaper, smaller plates. So I have to challenge you on this. From a purely traditional restaurant management perspective, driving your average check down is a cardinal sin.
Sure, normally it is.
If you have a finite number of seats, and you are intentionally lowering the revenue generated by each seat, isn't that a failure for the restaurant? How does management justify celebrating this as a strategic win?
On the surface, I completely agree. It looks like a misstep, but when you look at the underlying unit economics, it is a brilliant utilization of capacity. It is a deliberate trade-off of check size for visit frequency.
Oh, interesting.
Yeah. Management's data shows that the guests ordering from the lighter portions menu are returning to the restaurant at a significantly higher cadence.
So they are willingly taking a haircut on the individual transaction to increase the lifetime value or the annual value of that specific guest.
Precisely. And more importantly, it is driving traffic during specific day parts that historically have excess capacity. We're talking specifically about weekend lunches.
I see where this is going.
Right. If an Olive Garden is operating at 100% capacity on a Saturday night with an hour-long wait, pushing a lighter, cheaper menu makes absolutely no sense. You want to maximize the yield on every seat.
Because there's a line out the door.
Exactly. But at 1:30 p.m. on a Saturday, there are empty tables. The marginal cost of seating a guest at an empty table is virtually zero. If offering a lighter portion at a lower price point convinces a consumer to come in for lunch twice a month instead of once a month, you are capturing entirely incremental gross profit dollars that would have otherwise never existed.
Wow, okay. So they are essentially doing yield management, similar to an airline filling empty seats on a Tuesday afternoon flight.
That is the perfect way to look at it. And we know the strategy is accretive to the bottom line because despite that 80 basis point drag on the average check, Olive Garden still expanded its overall profit margin for the quarter to 24.3%.
That's the aha moment right there.
Yeah. They are driving enough incremental traffic and managing the food waste and labor tightly enough that the lower check average is more than offset by the volume.
It speaks to the broader philosophy of the portfolio. You have Longhorn driving massive premium checks and capturing the grocery trade down, while Olive Garden is utilizing yield management to capture high-frequency value diners.
It's very balanced.
And then you look further down the roster at the supporting cast. Take a brand like Yardhouse, which added $95 million in sales growth this year on a 5.6% comp.
Yardhouse is a prime example of operational pruning. Over the last 36 months, they have systematically overhauled their core menu platforms, specifically the burger, pizza, and taco lines.
Just stripping it down.
Basically. In a concept like Yardhouse, which traditionally has a massive, highly complex menu, kitchen execution can easily become a bottleneck. By simplifying those core platforms, they reduced ticket times, improved consistency, and drove their guest satisfaction scores higher. Better execution leads to faster table turns, which directly drives that 5.6% comp.
And we also saw evidence of active portfolio management, like M&A activity at the corporate level.
Yeah.
Darden isn't just managing the menus, they are ruthlessly managing the actual brand.
So absolutely.
They are currently deep into the integration of Choose, the Tex-Mex concept they recently acquired, pulling it into their supply chain and back office systems.
Wow.
But concurrently, they announced the permanent closure and conversion of 15 Bahama Breeze locations.
This is where disciplined capital allocation really shows up. It is very easy for a management team to hold on to underperforming assets due to, some cost fallacy or emotional attachment to a brand.
Right.
The decision to shutter 15 Bahama Breeze locations and convert the real estate into other Darden concepts, presumably higher yielding ones like Longhorn or Olive Garden, shows a strict adherence to return on invested capital. They look at a piece of real estate, determine that the current brand is not maximizing the cash flow potential of that specific dirt, and they pivot.
Which perfectly transitions us into the macro perspective. We've looked at the performance of the boxes, now we need to look at the health of the people sitting in the booths.
The consumer.
The billion-dollar question right now. Are consumers actually trading down or staying home in this economy? There's an endless debate right now about the state of the consumer. Are they tapped out? The demographic data Darden provided offers a highly granular look at the economic reality on the ground.
It does, and the data strongly contradicts the prevailing doom and gloom narrative. Darden reported that their casual brands actually saw an increase in guest visits year over year from every single income tier.
Wait, including the lowest income brackets? Because that is the cohort supposedly getting crushed by inflation.
Yes, including the lowest quintile. Now, management did add a caveat, speculating that the lower income traffic might have been temporarily buoyed by the timing of tax refunds during the quarter.
Sure, that makes sense.
But even adjusting for that, the sustained foot traffic suggests something fundamental about consumer psychology. Full-service dining, particularly at the value-driven price points Darden operates within, is increasingly viewed as an essential, protected indulgence.
Like an affordable luxury.
Exactly. Even when discretionary budgets are incredibly tight, the consumer is prioritizing the experiential release of a sit-down meal. They might defer buying a new television or, delay a vacation, but they are still carving out capital for Olive Garden.
That resilience is a massive bullish signal for the sector. However, the data wasn't universally positive. There was a very distinct demographic warning light flashing in the transcript, right?
There was. Management noted a distinct softness, a measurable decline in traffic, specifically from guests under the age of 35. This inevitably led to questions from analysts during the Q&A about whether Darden has a structural problem with younger consumers.
Right, the classic "are millennials killing casual dining" narrative. But management pushed back on that thesis, tying it directly to the labor market rather than shifting tastes.
They pointed straight to the macroeconomic data. The unemployment rate for the 20 to 25 age bracket has spiked to some of its highest levels in recent years. Furthermore, wage growth for that specific cohort has decelerated much faster than for older, more established workers.
So it's an economic squeeze.
Yeah. If you are 24, dealing with elevated rent, student loan resumptions, and a softening entry-level job market, a $40 sit-down dinner is the first discretionary expense to be cut. It is an affordability crisis for a specific cohort, not necessarily a rejection of the Darden brands.
I buy that to an extent, but it still represents a headwind.
Yeah.
Which leads us to the most critical strategic lever Darden pulled this quarter, and here's where it gets really interesting. This is perhaps the most important takeaway from this entire transcript. We need to talk about Darden's competitive moat and their pricing strategy.
It's fascinating.
When commodity inflation peaked over the last 2 years, the default reaction across the entire restaurant sector was to aggressively hike menu prices. Operators passed the pain directly to the consumer to protect their margins. But Darden deliberately chose not to raise menu prices as fast as inflation. Their blended pricing was up only 3.8% for the quarter.
It is a strategy rooted as long-term market dominance rather than short-term margin protection. By artificially suppressing their menu prices well below the actual rate of inflation, they are actively choosing to take a hit on their margins in the immediate term.
But if Wall Street evaluates you quarter to quarter, why willingly compress your own margins? What is the why here?
Because they are playing an infinite game with market share. Look at it from the consumer's vantage point. If a local independent Italian restaurant faces a 10% spike in food costs, they have no choice but to raise their menu prices by 10% just to keep the lights on. They don't have the balance sheet to absorb the loss.
Right.
Darden, with its massive cash flow, keeps its price increase at 3.8%. Almost overnight, the value gap between the independent operator and Olive Garden widens massively. Olive Garden suddenly looks like an incredible bargain. Darden uses its balance sheet to absorb the inflationary shock, which starves the smaller competitors of traffic. And once Darden captures those displaced guests, their internal retention data shows they can keep them over the long haul.
It is the brutal reality of scale. They are suffocating the competition by refusing to price gouge. But, you can only execute a strategy that aggressive if you have an underlying cost structure that allows you to survive it.
Exactly.
If you try to hold prices flat without a structural cost advantage, you just go bankrupt. This brings us to the foundation of the entire Darden operation, their massive supply chain advantage.
The Darden supply chain is the definitive moat of the business. Unlike the vast majority of restaurant operators who rely heavily on third-party broadline distributors, companies like Sysco or US Foods Darden operates its own highly complex, dedicated food distribution network. They source directly from producers at the farm level, bypassing multiple layers of middleman markups.
And the single most mind-blowing data point in the entire earnings call was regarding their poultry procurement. I couldn't believe this when I read it.
Yeah, the CFO, Raj Venam, detailed their chicken contracts. Because Darden is buying at such immense, predictable volumes, they are able to negotiate highly customized, long-term forward contracts with suppliers. They lock in the feed costs, they guarantee the producer a specific margin, and in exchange, they eliminate their exposure to the spot market.
And what was the result?
As a result, Darden's costs on chicken have remained virtually flat for the last 3 full years.
Flat for 3 years, during a period where the global supply chain completely fractured and the broader market saw roughly 5% annualized inflation on wholesale poultry. Darden simply bypassed the inflation entirely. That is insane.
It's an incredible achievement, and it's not just chicken. Management stated that their supply chain team consistently outperforms the broader commodities market by mid to high single-digit percentages across their entire basket of goods year after year. When you are purchasing billions of dollars of raw food annually, beating the market average by even 4 or 5% equates to hundreds of millions of dollars in direct bottom-line savings.
And that pool of savings is exactly what funds the 3.8% pricing strategy. The supply chain generates the cash allows them to suppress menu prices, the low prices drive massive foot traffic, the increased traffic scales their purchasing power even further, which allows them to negotiate even better contracts next year.
It's a flywheel.
It is a closed-loop, self-reinforcing economic engine that a 50-unit regional chain simply cannot replicate, let alone a single-unit operator.
And that structural advantage is exactly why Darden can confidently issue the kind of forward-looking guidance we saw for fiscal 2027.
Let's unpack that guidance. Let's translate the numbers. Management is projecting total sales for fiscal 2027 to land between $13.6 billion and $13.75 billion.
Yeah.
They are guiding for same restaurant sales growth of 2.5% to 3.5%. And they expect adjusted EPS to come in between $11.10 and $11.35.
Those are steady compounding growth figures.
But what jumps out is the sheer physical scale of our capital expenditure plans. They're projecting an $875 million CapEx budget for the year.
$875 million is a massive deployment of capital. During the analyst Q&A, management was pressed to justify exactly where that cash is going. The breakdown reveals an incredibly aggressive expansion posture.
Where is it all going?
Well, approximately $25 million is earmarked for the conversion of those 11 Bahama Breeze locations we talked about. Another $350 million is allocated for maintenance capital and heavy IT infrastructure upgrades across their existing base of over 2,200 restaurants.
Okay, that leaves a lot left over.
Right. The lion's share, a massive $500 million, is dedicated purely to new unit growth.
Which means they are targeting 75 to 80 gross new restaurant openings in a single year. That is a staggering logistical undertaking.
It really is.
Think about the real estate scouting, the permitting, the ground-up construction, and the hiring required to open 80 full-service restaurants in 12 months. It signals supreme confidence in their unit economics. You don't spend $500 million building new boxes if you are worried about the long-term health of the consumer.
You certainly don't. And they're modeling out very specific inflation expectations as they build. Management is forecasting total inflation of approximately 3% for the fiscal year, split evenly between 3% on commodities and roughly 3.5% on labor.
And the commodity forecasts, specifically around beef, was highly nuanced and crucial for anyone modeling this stock quarter by quarter. The CFO explicitly warned that they expect beef inflation to remain elevated in the mid to high single digits through the first quarter.
Yes, because they are wrapping over some artificially low baseline numbers from the prior year. However, the critical piece of guidance is that they expect the beef cycle to turn, forecasting actual deflation in beef costs by the second quarter.
That is vital context. It means if Darden reports slightly compressed margins in Q1 due to an elevated cost of goods sold, it is a known modeled event. The relief valve is already expected in Q2. And, the level of granular risk management they detailed is fascinating. They discuss tracking localized macro disruptions that rarely make the financial headlines but hit the P&L of a logistics company.
Right. They cited short-term fuel surcharges stemming from geopolitical instability affecting diesel prices, which created a 50 to 60 basis point drag on margins, though they expect that to ease. They even addressed analyst questions regarding a screwworm outbreak affecting cattle herds in specific regions.
I honestly had to look up what a screwworm was when I read that.
It highlights the reality of agricultural supply chains. Management noted that while they are closely monitoring potential state line restrictions on animal movement, their internal risk assessment views the short-term disruption to their overall beef supply as minimal. They have enough geographic diversification in their sourcing to just route around localized agricultural crises.
Beyond the domestic expansion and the supply chain, the transcript also revealed a very distinct shift in their international strategy. We saw announcements for new franchise agreements in Spain, India, and Canada opening this year. The CEO emphasized that this fiscal year will represent the highest number of international openings in the company's history.
It is an important strategic pivot, but we have to be clear on the financial mechanics here. Darden is not deploying its own capex to build corporate-owned Olive Gardens in Madrid or Mumbai. These are pure franchise agreements.
Right. An international partner puts up the capital to build and operate the restaurant, and Darden just collects a percentage of the top-line revenue as a royalty fee.
Exactly. The CEO was very transparent that the immediate financial impact will be minimal, describing the near-term accretion to EPS as single-digit pennies. But strategically, it is an exceptionally high-margin, asset-light revenue stream. It establishes a footprint for these legacy American brands in massive, rapidly growing global markets without subjecting Darden's balance sheet to international real estate risk or local labor market complexities.
It is basically a low-risk call option on global growth. Now, I want to pivot to a deeply debated topic in the restaurant space, one where Darden is taking a highly controversial contrarian stance. Delivery. Specifically, third-party aggregators like Uber Eats and DoorDash. Almost every major restaurant chain in America has eventually capitulated and integrated these apps because the volume of demand is undeniable. So why is Darden still refusing to put its flagship brand, Olive Garden, on a third-party marketplace?
It is one of the most definitive lines drawn in the sand by any management team in retail right now. When explicitly asked by an analyst if their 2027 growth guidance relied on finally adopting third-party delivery for Olive Garden, the CEO's response was a categorical rejection. They have established strict, non-negotiable terms, what they call their red lines, that the tech platforms have simply refused to meet.
Let's examine those red lines, because they reveal exactly how Darden views brand equity. What are they demanding from the delivery platforms?
There are three primary pillars. First, absolute price transparency for the guest. Darden insists that the end consumer must clearly see the baseline cost of the food versus the markup and fees charged by the delivery app. They refuse to allow a dynamic where a guest pays $35 for a plate of chicken parmigiana that costs $20 in the restaurant, and then blames Olive Garden for price gouging. They will not let a third-party interface degrade their brand's value proposition.
That makes perfect sense. The app degrades the value, but the restaurant takes the reputational damage. What is the second demand?
Control over their own consumer data. Darden operates one of the most sophisticated customer relationship management databases in the hospitality industry. They use that data to drive their localized marketing and yield management. They absolutely refuse to disintermediate themselves by handing that proprietary transaction data over to a tech platform that could, eventually use it to market competing restaurants to Darden's own guests.
Right. They're building a highly protective moat around their digital ecosystem. And the third line.
Tip protection and fair compensation for their own internal team members. Darden requires assurance that the complex logistics of the delivery ecosystem do not negatively impact the earnings of the staff executing the orders inside the four walls of the restaurant.
So until the aggregators concede to all three demands, which frankly fundamentally breaks the business model of an Uber Eats or a DoorDash Olive Garden, remains a holdout.
But they aren't abandoning delivery entirely, are they? They're just forcing the consumer into their own proprietary channel.
Precisely. Olive Garden operates a highly robust first-party delivery model. You can absolutely get Olive Garden delivered, but you have to go to olivegarden.com or use their native app to place the order. They then fulfill it through a direct white label partnership, avoiding the marketplace commission structures.
And the economics of that first-party model are staggering. Management disclosed that this first-party delivery currently accounts for 4.7% of their total sales. Furthermore, because they are not surrendering 20 to 30% of the ticket in commission fees to an aggregator, these sales are immensely profitable. They estimate that these first-party delivery orders are 50% incremental, meaning that half of the guests utilizing the native delivery platform would not have chosen to dine at an Olive Garden or pick up the food themselves if the delivery option didn't exist. Capturing highly profitable, fully incremental revenue without compromising brand equity or data ownership is a massive flex of consumer relevance. They possess the scale and the brand affinity to dictate the terms of engagement to the tech sector, rather than the other way around.
It is a remarkable display of leverage. Well, we have covered an immense amount of ground here, from the mechanics of same-restaurant sales to the intricacies of forward poultry contracts, the psychology of grocery inflation, and the economics of first-party delivery. To bring this all together into an actionable thesis, we need to synthesize this data.
Let's do it.
Let's construct the final verdict for the retail investor navigating this space. So, what does this all mean for the retail investor holding or considering this stock? I want you to lay out the bear case first. Based on the entirety of this Q4 transcript and the forward guidance, what are the legitimate structural risks an investor needs to weigh?
The bear case is built on a combination of near-term execution risk and long-term demographic friction. In the immediate term, the fiscal 2027 guidance requires a flawless execution of a massive capital deployment. They are committing to opening 80 new restaurants. That requires navigating zoning, construction delays, and localized labor shortages.
A lot of moving parts.
Exactly. Management acknowledged a $15 million pre-opening cost impact, roughly a 10-cent drag on full-year EPS, just to fund the training and operational ramp-up of these new doxes. If the macro environment suddenly deteriorates in the back half of the year, they are committed to $500 million in CapEx that will take significantly longer to generate a return.
So you are building aggressively into what might be a softening economy, and you have the Q1 margin pressure from the beef cycle we discussed.
Correct. The near-term margins will look pressured, but the more potent, long-term bear argument centers on that demographic softness we analyzed. The under 35 cohort is pulling back. While management attributes this purely to youth unemployment and macroeconomic pressure, a skeptic would argue there is a structural shift occurring.
That young people just don't want to eat this way.
Right. If younger generations, Gen Z and younger millennials, are fundamentally rejecting the 2-hour, full-service, sit-down dining format in favor of fast-casual, digital-first, high-convenience models, Darden's pipeline of future core customers is compromised. A brand portfolio heavily optimized for boomers and Gen X will eventually face a demographic cliff if it fails to cultivate the next generation of super users.
That is a highly credible risk. The format itself might be aging out. Now flip the perspective. What is the definitive, opinionated bull case? Why does this stock deserve a premium multiple in a notoriously brutal industry?
The bull case is that Darden is operating with an insurmountable structural advantage, and their track record of capital allocation is arguably peerless in the sector. The CEO explicitly highlighted that over its 31-year history as a publicly traded entity, Darden has generated an annualized total shareholder return in excess of 10%. They execute with a level of consistency that independent operators and smaller chains simply cannot match.
The mood is simply too deep.
Exactly. We discussed the supply chain. You cannot replicate their purchasing power. You cannot replicate their ability to hold prices flat while the rest of the industry alienates consumers with double-digit price hikes. Longhorn is taking massive, sustained market share from grocery stores and competitors alike. Olive Garden is demonstrating highly sophisticated yield management to expand margins even on lower average checks.
And their financials are rock solid.
Yes, they are doing all of this with a pristine balance sheet. Their adjusted debt to EBITDA ratio sits at 2.1 times, well within their investment grade parameters. They are generating immense free cash flow, and they are aggressively returning it to the investor.
Which brings us to the ultimate actionable takeaway for the portfolio.
For a retail investor, Darden represents a highly defensive consumer discretionary play. If you are modeling a protracted, choppy macroeconomic environment where inflation remains sticky and consumer wallets are stressed, Darden's scale makes it a definitive safe harbor. They possess the unique ability to manage supply chain costs and weaponize their pricing to take market share during a downturn. And crucially, you are being paid a very high premium to hold the equity while the macro story plays out.
Tell them about the dividend.
The board of directors just authorized an 8% increase to the regular quarterly dividend, establishing an annual payout of $6.48 per share. That rewards investors for waiting out any short-term macro bumps.
So you are getting the high beta growth engine of Longhorn, the massive steady cash flow generation of Olive Garden, a balance sheet that shields you from supply chain chaos, and an aggressive growing dividend yield to compound your returns while you wait.
It is a highly compelling total return profile.
This has been an incredibly illuminating breakdown of the mechanics driving a $13 billion physical retail empire. We've seen how generating that kind of top-line revenue requires far more than culinary execution. It requires a ruthless focus on operational leverage, yield management, and supply chain dominance.
It certainly does. But I want to leave you, the listener, with a broader, more provocative question to consider as you evaluate the sector moving forward.
Let's hear it.
We touched on the demographic headwinds regarding the under 35 consumer. Darden's current operational playbook, the sprawling dining rooms, the heavy reliance on massive dinner day parts, the traditional full-service hospitality model is brilliantly tailored to capture the disposable income of Gen X and baby boomers. But as those demographics inevitably age, the entire casual dining sector faces an existential transition. Will Darden's massive scale, their data infrastructure, and their legacy portfolio be enough to seamlessly capture Gen Z? Or will the future of full-service dining require a radical, ground-up reinvention of the real estate and the service model that simply isn't yet in the guidance?
It is the defining question for the next decade of restaurant retail. As always, look past the vanity metrics, study the mechanics of the business, and never stop questioning the numbers behind the news. We will see you on the next deep dive.